And crypto's the same. It's even got a faster, steeper curve over time. More and more people are flocking to it. The prices are down 80%. Well, between 50 and 80%. Let's say there's another potential 50% downside, let's say, because crypto is very volatile. What is the upside? Usually when you get to this kind of oversold levels, so I use stuff like the 5-year moving average, you find that the upside is 10 to 20x. So you've got a 0.5 downside, 10x upside, right?
It's been almost 3 months since Bitcoin, the world's largest cryptocurrency, fell from $30,000 and plunged below $20,000 in 12 days. As expected, the move affected the entire cryptocurrency market. By early July, the overall crypto market cap had lost over $300 billion from what it was before Bitcoin took the nasty plunge. Though there have been little moments of recovery, we've not gotten close enough to recapturing that crucial level. The reactions to the crash have been particularly mixed and biased in some quarters. For example, mainstream media have taken the crash as an opportunity to poke fun at well-known cryptocurrency investors like Michael Saylor and the crypto space in general. There have also been talks that the whole industry is a giant Ponzi scheme, a narrative that wasn't helped by the Terra implosion and the subsequent crypto contagion. But many crypto investors, ever ready for the market's infamous volatility, have been pretty chill about the news, patiently making their moves and waiting for the next bull run. According to data from Glassnode, the number of Bitcoin whole coiners increased by over 13,000 in just 7 days in June. The chart shows the massive rise as investors seized the golden opportunity to increase their Bitcoin holdings. According to economic historian, investment strategist, and Real Vision CEO Raoul Pal, this is the right way to invest in the cryptocurrency industry, because the same volatility that has brought the market down 60% can cause prices to shoot up almost overnight. In a recent interview, Pal talks about the ongoing bear market and suggests the best way for investors to position themselves before the next bull market. He suggests 3 asset classes depending on an investor's risk tolerance and time horizon. They are cryptocurrencies, growth, and stocks and bonds. He also discusses what investors stand to gain with each asset class and certain issues affecting the crypto space in general. We will now take you to Raoul Pal's interview. Please watch this video to the end and give it a thumbs up. You can also subscribe to the channel, turn on post notifications, and drop your comments and observations in the comments section below. Thanks and enjoy the video.
I would steer them to the 2 things that have been discounted the most, that have the higher potential upside. It depends what their their objective are. But let's assume they're relatively young and want to make capital gains. If they're relatively young, want to make capital gains, then the 2 areas that have been massively discounted are both crypto and the kind of very growth end of technology. And why those areas are, they're both in secular uptrends. Right? Technology is not going away. The EV revolution is not going away. The autonomous driving is not going away. Space exploration is not going away. AI is not going away. They're accelerating. Right? So if you've got this trend of adoption and rising prices over time in the share prices, and you're right at the bottom of that trend, you kind of know that this adoption is going to continue. There's no way that technology doesn't continue. So therefore, it gets incredibly cheap every day. It doesn't go up over time. And a lot of this stuff is down 80%. Things like Shopify or whatever it may be. So that gets really interesting. And crypto's the same. You find that the upside is 10 to 20x. So you've got a 0.5 downside, 10x upside, right? These kind of things don't happen many times in your life. So if you do have a bit of cash, buy what everybody's sold, not what everybody's buying now. And everybody's buying now. If we're talking about Dubai, people are buying property. Okay, that's been a good trade, but is it likely to generate 10x? No chance, never. Well, not in 5 years, not in 10 years, maybe in 20 years. So, or longer. So those are the opportunities I'm really looking at. Now, if you're risk adverse, but you still want to make some money out of this, then bonds, which is, everyone's going to go, what? But inflation means that bond prices go down. The point being is we've hit peak inflation. Now, whether the inflation rate headline rate stays sticky for a while longer, most commodities are down 30 to 50% already. We've seen massive inventory builds. So across all of the Western world, we've seen supermarkets with too much goods they ordered. Amazon with too much goods. They're getting rid of workers, and they're going to have to start discounting prices. The oil price is now starting to fall. It's just broken $90 as we're speaking. And, I think it comes down to 60. So that will be a 50% fall in the price of oil. So inflation comes down significantly, and bonds tend to do well. So they're not very volatile, so you're not going to lose a lot of money. But the chances are, you can make a decent return, not from the yield, but just from the price appreciation. And there's things like TLT, which is an equity ETF that mirrors 20-year bonds in the US. Very simple place to invest, very easy way to do it. So that's the other thing I would think of now as an opportunity, depending where you are in your risk.
As a 13-year-old industry, the cryptocurrency industry still has a lot of kinks to iron out. One of the issues is the issue of unregulated exchanges and their eye-popping 100x leverage offers. Pal also talks about the risk level of the cryptocurrency industry and how investors can make the most of the industry. Here is the other part of Raoul Pal's interview.
So if you remember, we've just talked about risk, where the low end of the risk was owning bonds and the high end was buying crypto and technology stocks. The same applies in all assets and all asset classes. So taking crypto as an asset class, so the least risky, the least volatile, the safest is Bitcoin. Still goes up and down 60 or 70, 75%, I think, peak to trough. So you need to be aware of the volatility, which is why leverage is not very useful in this space. It always seems attractive when prices are going up, but you get utterly destroyed when they go down. It's too volatile to use leverage. And I always say you don't need it. If we're talking about 10x, 20x returns out of Bitcoin itself or Ethereum or some of these big ones, why do you need leverage? Really? You're trying to make 100x on your life savings? Are you mad? I mean, you don't need to do that. These are big opportunities. So then when you're looking at the risk, what happens is people they suffer two things. One is the illusion that, Ethereum's at $2,000, whatever the number is, or Bitcoin's at 20,000, 30,000. I can't afford one, right? Which is a complete misunderstanding. They all fractionalize down to like 8 decimal places. What that means is you, me, the 23-year-old who's got $50 a month to put in the crypto market can all put the same percentage of our disposable income in and all benefit to the same percentage, which you can't do in other things, right? There's a lot of things in most financial markets that you don't have that equal playing field. So everybody can participate. So that's great. But everybody has this illusion about price. It's like, well, I can't afford a Bitcoin. You don't need a Bitcoin. You just buy whatever you want to do. Secondly, there is this illusion that everybody else is making money in these small tokens, and you see it, and it seems fun and exciting and gambling, and you kind of want to do it, and it gets your blood. Oh, I need to do this. I need to do this. Everyone's making money in the metaverse, and I'm not. They're making money in this NFT, and I'm not. And it's FOMO. It's actually fun in the space, the FOMO and the ridiculousness. And people joke, laugh with each other. I mean, we've got here at Real Vision, one of our Slack channels internally is like filthy degens because people are degenerative and they kind of embrace it. How I would approach this is understand that all of that degen trading of the NFTs, because in NFTs, it's harder to own the really kind of the real valuable assets. So you're involved messing around with a bunch of communities in pump and dumps and all of this, these small tokens. Knock your socks off, but do it with 10 or 20% of your savings, of your capital. The rest you allocate into the safer assets, whether it's Bitcoin, Ethereum, Solana, Avalanche, some of those big layer ones where you've got a higher probability of success. And again, the risk curve is Bitcoin is the least risky, Ethereum the next, then there's a whole bunch after that, the kind of Polkadot, Solanas, AVAX. And it doesn't mean they don't come without risk. We learned that from Luna. Things have risk. This whole space has risk, but the least risky Bitcoin needs. So I would construct a portfolio. If you do enjoy the degen activity and you want to enjoy that, I'm going to get rich on this thing, right? It's a human trait. Embrace it. The space embraces it. You ape into tokens, you have fun, you get wrecked. It's all part of it. And it also teaches you lessons. I'm stupid. I was following somebody. I didn't do the research. You learn a lot of good lessons from doing that stuff. And it's a bit boring to buy and hold. I mean, 90% of everything I do is just buy and hold. And I don't do anything with it. And it's kind of, you kind of always get a bit of FOMO. So I always have a bit of money for FOMO so I can just mess around and get involved in the community and the fun of it and the movement of it, because that's fun too. So that's how I'd approach it. Don't use leverage, because the whole game is to stay in the game. That is the entire game here. And you've got the two issues. One is you want to be a degen. So give yourself space to be a degen without destroying your capital. The other one is don't lose your capital.
As Raoul Pal has explained, the general rule of thumb in the cryptocurrency sector is the higher a crypto asset is on the list, the less risky it is. So we would start from Bitcoin, then move to Ethereum, Tether, and USDC before moving on to other altcoins like XRP, Cardano, Solana, and Dogecoin. Though there is no crypto asset without risk, this is the preferred investment strategy by many investors in the space. What is your preferred strategy? Do you allocate by market cap and dominance, or prefer to jump on the newest projects in the industry? Please drop your replies in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.